Hi everybody, it's Steve Jagger, co-founder of Addy. Today we've got Mark Goodman and Ian Brackett here from Goodman Commercial to talk a little bit about what is going on in the Vancouver commercial real estate world. So thanks guys for joining me.
Thanks, Stephen.
So maybe can we just jump into the kind of the quick history on what is Goodman Commercial?
Yeah, well, Goodman Commercial is a real estate firm based in Metro Vancouver. Our focus is multifamily investments in land. We also do industrial, but most of our focus is development land and apartment buildings. So your typical wood frame, 3-story, walk-up buildings to concrete high-rises. And also new builds, forward sales, properties that have not been constructed yet but are going through the entitlement process. And so that's our world. And we also publish the Goodman Report, it's been around since 1983. And we have quite a large audience. We probably have about 150,000 followers through all our different marketing channels. And it's mostly BC focused, but it's national. It's across Canada and around the world.
Nice.
Yeah.
Nice. And then Ian, what's your background? When did you join?
Yeah, I've been with Mark for just over 2.5 years. Prior to that, I was at Altus Group, which is a national commercial real estate appraising company. And so I was doing land appraisals, valuation, consulting, all that type of stuff.
Nice. So maybe can you start with what's going on in the Vancouver commercial market? What are you guys seeing right now with where we're at?
Yeah, that's the proverbial question.
Is it good? Is it bad?
Well, we're definitely in a better environment now than we were a year ago. I was recently in Toronto speaking at the apartment conference, which is an annual where all the big players across the country converge in Toronto, and we talk about what's happening in the real estate market. And I think we finally are seeing some relief, particularly with interest rates. That has helped more liquidity in the market. But for the last couple of years, 2.5 years, it's been a difficult, challenging environment, for brokers trying to sell properties, for apartment owners, wanting to sell or pivot from their existing asset into something else. It's been challenging from a legislative standpoint, whether it's municipal, provincial rules that at times inhibit or change the value proposition of owning, managing, and building apartment buildings. I was suggesting that the worst is over now. There's light at the end of the tunnel. We're seeing a lot more deal velocity now, a lot more interest in our offerings. Ian and I have sold 3 buildings in the last 2 weeks, multiple proposals on the go. So generally, we've come out of this very dark period, and we haven't seen a cycle like this in 30 years, where the market just got hammered, basically.
And so when it's a tough market like that, interest rates go up, which makes it difficult for the buyer to make the property pencil.
Yes.
But I'm assuming if the seller just dropped their price, if they really wanted to sell, it would make it work for the buyer. Is it hard because the seller sees a price or has a price in mind that they're not willing to dip, and the buyer has the problem with trying to make the numbers work, and is that the problem? They just can't meet?
Yeah. There's this delta between buyers' expectations and sellers' expectations that we've never seen before, at least not in the 23 years I've been selling apartment buildings. And that delta is shrinking now. So we're coming back to a more normal environment. But I would say that interest rates went up 5 times, 5-fold in a matter of a couple of years. We've never seen anything like this, at least in recent history. So when you were borrowing money at 1.5%, and then over a 2-year period, if you went to the bank, you're over 5%, that changes the equation very quickly. And so, cap rates, we used to see them sub 3%. Well, you were borrowing money at 1.25%, 1.5% for 5 years, and you were buying an apartment building at a 2.5 cap. You had that positive leverage, and there was a value add proposition. As tenants moved out, you would turn over the units and increase the rents anywhere from 50 to 150%, depending on the building. But when interest rates moved to past 5%, the market didn't embrace a 2.5%, a 3%, or a 3.5% cap rate anymore. The cap rates got pushed well over 4%. Well, at that point, the higher the cap rates requirement for a buyer, the lower the price for the seller. And it got to a point where, if you had purchased a building after 2016, likely you'd be losing money if you were selling in that environment. This is a year ago. Now that interest rates have come down, you can get 5-year money, CMHC insured, for about 3.5%. Cap rates are hovering around 3 to 4% depending on the asset and where it's located. Now all of a sudden that delta is shrinking. So I think you've nailed it. Like the seller was not willing to take a loss. There's very few distressed buildings in the apartment market. Most investors are not highly leveraged, or there's enough equity in the building. They don't have to worry about being squeezed. Usually where we're seeing a distressed environment is in land and developers who got caught.
Yeah. And so we're going to talk about the land piece, but before we jump over to that, can you talk a little bit about like who are these people or businesses that own the buildings?
Yeah.
Like you always hear foreign money or the big REITs own everything. Like what do you guys see as the sort of the standard owner, especially when you're saying like when the environment changed, they want to sell their building, but they're not getting the right buy, the price, and they've obviously got the ability to just hold on, just wait, right? They're not in any rush. But like, who is this sort of the average, or is there an average?
Yeah, I mean, there are about 3,300 purpose-built apartment buildings throughout Metro Vancouver. So that's, from the city of Vancouver right out to Maple Ridge and Mission. And those 3,300 apartment buildings are controlled and owned by about 22 to 2,300 individuals, companies or private families or individuals. Out of that rental stock, about 90% is wood frame, your typical wood frame walk-up, and some mid-rise.
Kind of like what you'd see here in Kitsilano.
Exactly.
This normal stuff.
Exactly.
Right? Yeah.
And then 10%, concrete and some strata titled buildings owned by one owner. So they've kept it rental. And predominantly, a lot of these buildings, most of the buildings were built in the 60s and 70s. There was a great environment to build. The developers were incentivized to build purpose-built housing. And a lot of immigrants came and built these buildings here from, a lot of Eastern European families immigrated here and built what you see today. So your typical owner right now is a family-based business, an individual. They've had it in the family for decades. 10% of the transactions year over year are generally purchased by institutional groups, so REITs and pension funds. This narrative and vilification of corporations coming out and taking over and the financialization of real estate, I mean, that narrative is really tired. This vilification of apartment owners and landlords is ridiculous. In fact, we should have more institutional money here and more corporate money because they play by the rules, they're transparent, they're accountable, and they're not kicking people out on the street and all these stories that you see. It's been politically expedient to use that narrative in order to somehow justify certain rules and regulations and the reason why we're unaffordable. So anyways, I'm going on a bit of a tangent here, but most of the owners are private, and we're not a mature market like other cities where you see this transformation from private to more institutional corporate. We're still
we don't
private.
have the scale.
That's right.
In a lot of cases, institutions want 100+ unit buildings,
Right.
which just you don't see that many around Vancouver.
Right. So this is just too small.
Yeah.
For them.
When-
We've heard that is like they want to spend $100 million plus or whatever it is, and a lot of the buildings I'm assuming are 10 to 40 million or 50 million for the vast majority of them.
Right, for the typical deal, yeah.
Yeah. And so for you guys, when you're usually on the selling side, or you're on the buying side of these transactions, or both?
I mean, I'd say 95% of our mandates are as a listing agent.
Right. I get your emails. I see the solds all the time.
Yeah. I mean, from time to time, Ian and I will take on a buyer, but we're just fortunate to be very busy with listings, and that's where we pour all our energy, and our value proposition is marketing properties. That's what we're known for, and our distribution system. But, we recently, a few months ago, sold a property to a nonprofit. We acted for them as a buyer and helped stick handle to navigate the acquisition process. So it really depends. From time to time, we'll do like an off-market deal if we're able to bring buyer and seller together, and if they don't want that exposure, the seller or the buyer has a specific property in mind, and we may call a few owners, but it's really not a main part of our business.
The off-market part?
Yeah.
I was just going to ask you about that. Like what percentage is sort of truly off-market where it quietly just transacts?
Like less than 5%.
So most of these buildings go onto the MLS. They're put out there to the world. For sale sign goes up.
Not on the MLS. I tried the MLS once like 7 years ago. It doesn't really work for our market for numerous reasons. Most properties that go on the MLS are listed by realtors that don't have the market knowledge or distribution list. It doesn't really work for our market. There's certain rules and regulations to comply with the real estate board guidelines. For example, you need a list price. Some of our clients don't want a list price. They want something that's quiet, not published, or they want an open bid process where there's no official price. If it's listed on the MLS, you have to show a building within 1 week of an inquiry. I think it's a week. But, you're going through people's homes. There's tenants. We don't just drop everything and show. We want to make sure they're qualified before we start trucking buyers through someone else's home.
So doesn't that doesn't make it? I was thinking off market. If it's not on the MLS, it's off market deal. Is that not how you guys categorize it?
No, an off market deal would be where it's not officially listed, so you don't have a mandate. You don't have the listing. You're kind of just...
Oh, you just kind of know that
you pick up the phone and you call the seller and say, hey, Bob, would you consider letting go of your building? He says, well, maybe bring me an offer. And then you find a buyer, and then there's no listing. Maybe you'll have a commission agreement at the end. But there's no marketing. There's no mandate. It's not out there. I would say that 90% of the transactions in multifamily do not happen on the MLS system.
Right. And this is why we talk about it in Addy all the time around this world of the sort of commercial grade real estate happening between your people on your email list and the seller and the buyers. Like the general public doesn't really see it. There's sometimes not a for sale sign, and just a transaction happens. And so in Addy's world is like you need to have the money to be able to participate and buy these buildings, or to even play. And then the other side of it, you also need to be in the know. Like if you're not in the know but you have the money, you still have a problem. Like you need to be on kind of both sides of having the capital and knowing what's out there.
I think the MLS system is less prominent now, particularly in the commercial real estate sector, because there's so many other platforms that do a better job. And similar to what Addy's done, where you've democratized real estate and you can now open it up to the world. Similarly, the internet, whether it's social media, whether it's on LinkedIn, like we have 32,000 followers. We post something on LinkedIn, and we could have 100,000 impressions within a couple days. Our subscriber list, we have tens of thousands of people that receive our information. You could Google apartment buildings for sale, and our listing will come up. And so the value proposition that MLS has is not there for brokers anymore, or for the consumer. It certainly works for residential, but not in the commercial real estate world. Yeah.
Okay, can we switch gears and talk a little bit about sort of the land use side of what's going on in Vancouver or Greater Vancouver? Maybe we can start with the transit. What is it? Transit oriented areas, the TOA.
yeah.
Can you tell us a little bit, like, what is that? We were talking earlier, they've changed the name, but now it's TOA. Like, what does that mean? Who made these rules? How does it affect your guys' world?
Sure, yeah. To start from the beginning, it's a provincial mandate. I think it was Bill 47, that basically forced all the cities in British Columbia to pass their own land use plans that are meant to encourage development around transit. So all the SkyTrain stations, major bus loops, all that type of stuff across the whole province. The provincial part of it was basically just to set a minimum height, a minimum density. They then put it in the city's hands to go and make all the rules around that. So what the province did doesn't actually enable any development, but they're forcing the cities, you guys have to pass your own plans to enable that development. So until June of this year, there was a deadline. Cities had to pass their own land use policies. That's come and gone. Each city has kind of taken a different approach to it. Surprisingly, the city of Vancouver, which is the biggest, most complex, they've had the most transit stations, they've actually been kind of a leader on it. They've passed a full detailed policy that says, you can build this much density, these are the uses. They've put all these rules, so at least you have certainty. There's parts of what they've passed that aren't great policies. They don't make sense financially, but at least they've put all the rules out there so developers know what they're dealing with. Other municipalities have not been as enthusiastic. Burnaby, for example, has twice deferred passing the legislation, so they don't have any TOA right now in Burnaby.
Even though they've got a bunch of stations and
even though, they're one of the biggest areas, and for years they've had tons of development around their major stations.
Like Brentwood seemed to explode.
Metrotown,
Metrotown.
Metrotown,
yeah, and for whatever reason, politically, they don't want to comply with what the province has told them they have to comply with, and so they're basically pushing it down the road and saying we don't want to deal with this. So we're kind of in a bit of a gray area of what the province is going to do with that. But what it does is it opens up. So there's a ton of land around all the transit stations that now all of a sudden have new policies where you can build, and it's a step system, so it's based on a radius, 20 stories, 12 stories, 6 to 8 stories, depending on how close you are to the station.
From the station out.
Yeah.
It's like you get a circle around the station.
That's right, yeah. So the
Seems
closer you are, the
clumsy
more
way to
density.
do it. Like I don't know. There's got to be like certain areas where the circle doesn't make total sense.
There are,
They
for
should
sure.
carve places out, carve places in. I don't know.
There's definitely some funny. I've seen, like in North Vancouver, there's one that kind of jumps across the river, and so you're within that distance, but you actually have nothing to do. Like you can't walk to that station.
Right.
Which I think that's the municipalities. That's probably their main. A lot of them aren't too pleased with it. Politically, it's a bit of a clumsy way to do land use planning,
Totally.
but.
So how did it work? People always, or at least when I sort of talk to people sort of socially around these TOAs coming, like if you owned a single family lot near one of these future stations or new, like did you just, hit the lottery and nail it? Is it that simple that some developer comes and buys your house for $30 million and you move on, or it's not that simple?
It's not that simple. There's a ton of details in the policy that water it down, and so like for one example, you have to have minimum frontages. So you have to have, in that case of the homeowner, you have to have enough of your neighbors that are all on board, willing to sell at a price that makes sense, and it's not all. There's areas within the TOA that don't make any financial sense to develop, like that house that's sitting there or that apartment building that's on that site is worth more than what the land value is with these rules that they've put in place.
Right.
So you can increase the density, but if you layer on all the fees, the below market housing requirements, the conditions in the market right now, so it makes it so that financially it just doesn't make sense to build in that area.
And this is where some of these developers have gotten into trouble, right? Where they've picked up some of these houses, but they don't have all of them or enough of them, and they basically have to kind of wait, and their interest sort of burns their money while they're trying to figure out exactly what they can do. That seems to be like the sort of the riskiest piece of all this.
Yeah, it's been a tough
the
time.
land banking aspect.
Yeah.
Well, more not to do with the TOA, but over the last couple of years, if you bought a piece of land 3 or 4 years ago where the market was very strong and interest rates were much lower and construction costs were much lower, and by the time you went through the entitlement process and you're ready to build and you're looking at your pre-sales and you were hoping to hit $1,500 a square foot, but you can only hit $1,100 a square foot, and your construction costs went up 50%. You can't find labor, and on top of that, you're carrying debt. That's 50% higher than what you expected. Now you're in a negative cash flow, and that's why we're seeing all these foreclosures happening right now.
And you might have thought you were going to do pre-sales in 24 months and budgeted for that much interest and carrying costs, and all of a sudden that's pushed way out.
Right.
So your costs are gone way up, your monthly mortgage is way up, and you're going to have to hold it for a lot longer than you expected.
Yeah. Well, I think the interesting piece, people are so negative on, especially some politicians, on the investor, but you really need those pre-sale investors, which is mostly investors, because they're the ones willing to put the deposit down and wait 4 years or 5 years for the unit to be ready, versus someone who's trying to move and needs a place right now. The pre-sale doesn't really work.
Yeah.
I mean, there's a whole movement now to encourage foreign investors to come back to BC, to come back to Canada, because it was actually a net positive for everybody. This idea of financialization and speculation and driving up costs. That's not the case. Without these foreign investors, we're not able to get a lot of these developments off the ground and build housing.
Right.
And the pre-sales from offshore money was a really good way for developers to help finance the project. And then a lot of these condo units went back into the rental pool. Mm-hmm. So we were actually supplying, some of these buildings, 30-40% become rental.
Yeah. This is like the mom and pop. They've got one unit. They're just renting it out.
Absolutely.
And I'm sure some of them went Airbnb, but they've kind of crushed that. So even if they let those pre-sales come back in, or that money come back in, they would go, if they're not going to move into it, they go rental, long-term rental.
Yeah. I don't have the exact number, but it's something around 40% of all the rentals in the region are those secondary markets. So condo rentals, basement suites, houses that are for rent. Right. So if you make it so that those investors, and most of them are not foreign, most of them are just local professionals, people that have saved up some money and put it into a single condo unit. Yeah. If you take them out of the market, that the amount of rental units is going to drop by 40% of what we have now. So it's a huge impact.
Right. That's how I started my real estate journey. I bought a single condo downtown Vancouver. I lived at home at my parents' house and bought a condo. My parents were like, "Great, you're moving out." And I was like, "No, I'm not moving out. This is an investment property." Well,
you got mom cooking dinner.
Yeah, so I was like, the food's great here. I'm not going anywhere. So can you guys talk about like the Broadway plan? The Broadway plan is separate to that transit-oriented areas plan. Is the Broadway plan in Vancouver, is it working? I see that huge tower that's gone up at Granville and Broadway, which is it's massive. Is that the future of the Broadway, like the street? We're going to see these monster towers all the way down it?
The short answer is probably no. That is unique because of where it is at, right on the intersection, on top of the station. That actually got approved before the plan was approved, so that's why you're seeing that one is done and nothing else has even started construction yet in the plan. It scales down. Most of the plan is going to be nowhere near that size. And in terms of if it's successful, it's created a lot of interest. There's 150 applications in, mostly for towers. Mostly all but there's 21,000 units, all but about 1,500 are for rental units. So in that sense, it's great. The city needs all these new rental units to get built. The question will be how many of those are actually feasible, how many will get built. Some of the policies that were put in place encouraged everyone to jump in right away, because there's an allocation on each block of how many towers can get built.
Oh, I've heard that there's you can do 2 or 3 or whatever. So if your neighbors got their approvals then and you didn't do yours, you're not building a tower. You've missed the window for that one block.
So anyone who owns a property, you better get your application in before the rest of your block fills up.
It created chaos.
Yeah.
Yeah.
But did it create demand of let's move these things quicker, or no, the chaos was not worth the pain?
Well, they did change in some areas. They relaxed the maximum requirement from 2 towers to 3, I believe. Or no.
The Broadway plan came before the TOA. When TOA came through, the city realized we need to take away these restrictions that are closest to transit station. So in certain parts of the Broadway plan, they're right now debating getting rid of the tower allocations. So within that block, there's going to be no more limit, and there's still restrictions on building towers because you have to be a minimum distance from any other tower. You can't go right up against it. There's an 80-foot separation
between the 2 towers, so the podiums need to be lined up so the towers are far enough apart.
So naturally, there's only going to be a certain number of towers that can fit on any block.
Right.
But it's not going to be a strict only 2 no matter what.
But what's interesting, when the TOA came in, Vancouver was one of the leaders because they were able to really mimic the rules and regulations from the Broadway plan with their minimum frontage requirements, the towers per block, the affordability component, and they were able to use that template for the TOA. So they were ahead of the game. The other municipalities, as Ian pointed out, Burnaby, that's basically rejecting it, and other municipalities are slow to go through this process. But in many cases, the density in the Broadway plan is higher than the TOA legislation. So in that case, the Broadway plan rules and regulations would stand. In other areas throughout the city, the TOA's density and height are higher than whatever existing plan in that municipality. So that would take precedent. But as Ian said, like, just because you're in a plan and it calls for redevelopment doesn't mean that it changes the highest and best use to redevelopment. Depending on the municipality, like the further you leave Vancouver, the lower the land values are. And if you're in an area where you're not getting a 6.5 FSR floor space ratio, which is what, 20 stories? 20 stories. The farther you leave Vancouver and the farther you are away from a transit hub, maybe they give you a 3.5 FSR. Well, the existing improvement on that land in that area, in most cases, is going to be more valuable than a developer coming in and buying the land to redevelop. So just because an area has been slated for higher density doesn't mean that it's going to change the land use in that area for quite some time.
Right.
Like it's really hard, as Ian said, like the city's giving you density with one hand, and then they're taking away with the other. They're, you know, when you add a below market component, it's a drag on the pro forma, you know. So it's not easy to make the numbers work, and developers are not making massive windfalls. The margins are typically very low, and they're shrinking. And you know, I think that we should be very thankful that developers are willing to take on these challenges and go through the cumbersome entitlement process and take on the risk. I mean, it's significant.
I agree. Like we hear it all the time in the news, or you hear sort of clips on the internet of like the big bad developer and they make all the money, and it's like the risk they take is immense.
Well, it's immense, and we're seeing many of our clients are in trouble right now. And these are family-based generational businesses. These are human beings that are in a lot of trouble right now. And it's sad because, you know, Ian and I are on the front lines. We have court-ordered sales right now. Nobody should be thinking that this is a positive thing. And, you know, this is not good for anybody. And these developers, they're helping the community. They're building schools. They're building daycares. They're helping the infrastructure. They're doing everything that our community needs. And they're one part of the puzzle, but they're very important.
On the foreclosure side, you mentioned like what are some of the scenarios that you guys are seeing? Like how are these guys ending up in foreclosure? They're sitting on land that the interest rates have sort of pushed them to where they can't even afford to hold, or they're like mid development and something's gone wrong or couldn't pre-sell enough. Like what kind of scenarios are you guys seeing?
Well, we had a client that family-based business that did quite well with like wood frame developments, low rise, for many years in various suburban areas. And then they started getting into high rise, big concrete towers. Didn't have a lot of experience in that, but they had done quite well and they had a background in development. And the market, the perfect storm, everything that could go wrong went wrong. They paid a price at the top of the market. They had an interest-only loan, floating with prime. That shot up. Construction costs went up 50%. And then when they launched a pre-sale program, they weren't able to hit their numbers, and the banks started to foreclose. They were into it. We had one client would say into it for $25 million. And when the offers started coming in, they were all around $10 million.
Oh, that big drop. Wow.
It's significant. I mean, that's an extreme example, but this is happening throughout the entire city. I mean, we've had more foreclosures and court-ordered sales than I think ever. I had never seen this amount of activity. And it's happening, to all different types of developers, not just new to the game or undercapitalized. Like even major players are having issues.
Wow.
So it's just it's a confluence of factors, and it was the perfect storm. And we're going to be seeing this for several more months.
On the flip side of that, does it scream opportunity to somebody who's cashed up and ready to come in and buy some stuff?
Absolutely. We're seeing it. The smart money is out right now, not just for development sites, but for apartment buildings. We've sold 3 buildings in the last 2 weeks. Concrete high rise.
I saw the one you just emailed about the other day. It was a tower, right? 20 stories or something?
Yeah, well, it was, I can't remember how many stories.
12 stories?
12 stories, 41 suites, west of Denman, just beautiful building, well maintained. It's been in the family for years. And another private family-based business purchased the building. It closes in December. All cash.
I was going to say, is this the all you mentioned in the email? It was an all cash deal.
Yeah, all cash. The father and son walked through the building. We went through each unit. No building inspector. I mean, they know what to look for. And but that building 3 or 4 years ago would have traded below a 3 cap at over $600,000 a unit. We're talking like blue chip real estate, views of English Bay, really well maintained. And I can't release the sale price now, but we listed it for $511,000 a unit, or $513 at a low 3 cap, and there was it sold. There was a little bit of movement on the list price, but we've probably seen a 25% drop per unit in this West Side prime real estate in the last 3 or 4 years. So now these investors, generational money, family-based businesses who are, play the long game are realizing, okay, well, if there was ever a time now to buy these type of trophy assets, it's now. Because historically, if you take a very long, multi-decade view of the market, there's this magical blip in time right now where prices have come down, and I don't see that lasting very much longer. We sold another building, a small building close by here in Fairview. It was a strata title building, 10 units. Very rare to have a strata title building owned by one owner.
Running as an apartment.
He built it in 1999. It has an elevator, which is rare for a walk-up building. It has underground parking, which is rare. So it was just a really nice, well-maintained building. And the buyer has an exit strategy. They could actually sell off the units if they wanted to.
We saw that with one of our buildings. Steve Evans brought the Lex. I don't know if you guys remember the Lex building in downtown Vancouver on Bramble Street.
I remember that one.
It was running as an apartment building. He bought it. He put it on the Addy platform. 1,500 investors participated in it. And then he almost immediately chopped it up and basically sold off all of the apartments individually, kind of at the height of the market. This happened a few years ago. Nailed the timing, and everybody did really well. It was like a 23 or 24%.
Oh, I got to remove that building from my database now.
There you go. Yeah, because it's all been broken up to individual investors. But that was kind of the sort of the sneaky thing about it. It was already stratified, but just running as an apartment building.
Mm-hmm. Yeah.
And the other building that we sold in Marpole, this is an interesting market. We've been really active in Marpole. There's about 12 or 13 listings there, and they're all hanging in the market, ranging from $290, $300 a door, right up to $375,000 a unit. And, cap rates range anywhere from, 2.9, 2.8, all the way up to close to 4. And of course, there's suite mix, there's condition, where it's located in Marpole. But, there's been a lot of products sitting on the market. And when I met with our client, I said, look, here, I sat down with her. Here are the 12 listings on the market. This is what you're competing with. Here's what's sold. We're not looking at what is sold recently as sort of the guidance, because a lot of these sales happened 2 years ago in a different market, right, when interest rates were lower. So we're actually focusing more on what's listed and to undercut the competition. And my client says, okay, well, let's list it. Didn't listen to my advice, and let's list here. And I'm like, okay, well, you're in the middle of the pack. There's nothing exciting for an investor. She's like, well, let's just see. So we went to market. We did our marketing program, and it was crickets. Nobody was interested. We reduced the price by $800,000 or $900,000. So we went from $300,000 a unit right to $285 a unit, and we sold it unconditionally. We had 8 or 9 groups to the building. 2 days later, multiple offers, unconditional offer. So what that demonstrated to us is that there is a market. And you asked, is it because they're just not interested? Is it the buyer, just is waiting for the number that makes sense? Yeah, there is a lineup of buyers there. As long as it meets, it's not like there's no market. There's a huge market. It's just, it's got to be priced right. And so the moment we release an offering that makes sense, where there's a value proposition, we're hitting these deals. So it was really interesting. $285 a door, sold at a 3.5 cap, I think, at the end of the day, probably. $285 a door for wood frame, west side. I mean, Marpole's not South Granville, it's not Kitts, it's not Kerrisdale, but it's still a decent neighborhood in Vancouver. That's really good value. Marpole was trading in the high threes, $400 a door. So, if for your investors in your community, if there was ever a time to buy rental housing, I would say now is probably the best time we've seen in a long time.
Nice. So, as far as what the future looks like for what you guys do, this market going forward, can you talk a little bit about where are we going in the next year or two? What does the next 10 years look like? Yeah. What are you foreseeing?
Your crystal ball.
Yeah.
I mean, I think for the last 2 years, we've had a lot of clients that are, we're coming off this massive high of 1.5% interest rates, which was that was never a normal market. That was a crazy, everyone was buying, everyone was making money. I think things are going to be much more steady going forward. I don't think the rates are going to drop back down to 1.5 and all of a sudden the market's going to take off again. I think it's where prices are today, it's probably just going to slowly tick up. And interest rates, I mean, if you talk to a lot of smart mortgage brokers, they tell you the rates today have already baked in future cuts that we're expecting for the next year, because when you're buying an apartment building, you're financing through CMHC usually, which is you're taking on a fixed rate mortgage, you're not floating with prime. So what you're getting today may be how it's going to be for the next couple of years.
Right. So no big changes like these TOAs or big new fancy Broadway plan or something equivalent to like a Marpole. There's nothing crazy that's coming down the pipe that
there probably will be. But it's like we're saying, it's not, even if that does happen, it's not necessarily a big home run. Right. Within the Broadway plan, a lot of properties haven't changed value because the numbers just aren't working right now. So you're not even. I mean, there will be some areas the city's trying to grow. They're bringing through new land use plans. I mean, if they do make a big change, then there could be some pockets where things change. But.
Okay. Can I ask a question? What would stop, and maybe the cities already do, I don't know if you guys know, but if any city knows that they're going to do something, they're going to approve the Broadway SkyTrain to UBC. Mm-hmm. Why doesn't the city buy up the land themselves before they make any announcements? They'd have to do it sneaky and quiet so that the you guys of the world are like, hey, looks like the city's acquiring along this line. Why don't they do that so that they see some of the value? Because they're the ones making the decisions that then the developers swoop in and try and
First of all,
maximize
you're
on it.
making an assumption that they move forward in logical ways. So I mean, these are good questions, and I also think, go ahead.
I was just going to say, to some degree, they are doing that because TransLink has now been authorized to start buying.
I saw
property.
that because that seems super logical. If you know where you're going to put the station and you're the person putting the station there, like what would make sense to own some of it around that where you're about to announce?
On the Arbutus and Broadway station, they've partnered with PCI to do a mixed-use project. I don't know how the partnership works exactly, but they're going to participate in
But
that.
it seems like a good way to extract some of the value that they create by changing zoning.
I wonder if that would be a conflict. It's really hard to keep it on the down low.
Well, that's what I don't even know how you would do that
No, I don't
at
think
scale. Like you guys would I would figure it out pretty quick of like this random numbered company and this thing's like
we'd wave the flag on the Goodman report.
Yeah.
They wouldn't like us very much.
Right.
They wouldn't like us very much.
Okay, and so is there any other sort of big changes that you expect to come? Is it like
I think, as Ian said, coming off this like crazy market, when COVID hit in 2020, early 2020, there was a surreal pause for like 2 months where like nothing was happening. And because we're an essential service, I was coming to the office, all our staff were working remotely. It was a skeleton crew because you have to stay open. We had like a conveyance and reception, that was it. And it was my life for 2 years, Zooming. And then all of a sudden, when they brought down interest rates, we did more business in that 2-year period than ever. Like
just went crazy.
2021, we did over $500 million in sales, 39 firm deals, 23 of which were unconditional offers. It was so busy, Stephen, that like we'd list the property, everything was by Zoom. Half the buildings I wasn't even showing because I couldn't get in. And we were preparing our purchase and sale agreements in advance. We'd have an unconditional offer template and a conditional. And it was like, it was a very strange environment. And that was our life for 2 years. And then things obviously changed as interest rates crept up. But I think, as Ian said, we're going to be in a much more balanced market. It's funny when people say, we're going to wait for the market to get better. And I'm like, what's better?
What does that mean? Yeah.
Because the market's actually decent now. This is a normal environment. We still have historically low interest rates. What we had before, that was like fantasy land. That's not normal. And now we're in a balanced market. I think what's going to impact the market going forward is any political changes municipally, provincially, even federally. I mean, they removed GST from new purpose-built buildings, which offered some relief to developers. But in return, the municipalities were like, okay, well, we'll jack up the DCCs or we'll do this. So until we have leadership on all three government levels that are aligned to encourage rental development, until that happens, the supply-demand imbalance that we're seeing now in the rental market is not going to change, where you have overwhelming need for housing. You have a government that has put policies in place where they idealistically thought would encourage development, but realistically are doing the opposite. So now you have constrained supply, increased demand. So for the foreseeable future, rental rates will continue to go up. Vacancies will continue to go down. And the apartment business, and that's why we have all these major groups out of Toronto buying in Vancouver, because they see that delta and it's pronounced, the supply-demand imbalance. So I think if you buy an apartment building today, you have to play the long game. You have to wait for turnover. Spend the money. Spend $20,000, $30,000, $50,000 a unit. Take those rents up from $1,200 to $2,500. Offer in-suite laundry and dishwashers. Do it up nice, particularly in West Side neighborhoods where they can absorb those new rental rates, and you'll get your cap rate from a starting cap rate at 3.5. You could project a 5.5, 6 cap over a few years. That's the value proposition. It's a very safe way to invest your money, and of course there's appreciation. But again, like if you look historically, there's been a very pronounced dip in the multifamily market, and I foresee 2025 is going to be a lot more active. I don't see there's going to be a huge boost in values, just because I think we're just finally getting back to a place where people are willing to spend money on rental housing and get back into the business. But we have this magical moment in time right now where the numbers actually look pretty good, particularly if you have a long-term investment horizon.
Nice.
Yeah.
Well, I think that's probably a pretty good place to wrap it up. The Goodman Commercial, you guys seem to sort of punch above your weight, right, as far as size goes of the firm, but you seem to be doing everything. If people wanted to get in touch, get the report that you provide, like how best to kind of follow along, subscribe to your stuff, where do they go do that?
Well, you could sign up at goodmanreport.com under the contact section. We send out, listings, sales, and research, and anything noteworthy probably once every 2 weeks, sometimes more within a week if we're very active. You can follow me on LinkedIn. We've got 32,000 followers. Just Google Mark Goodman and follow. That's more of like a real-time kind of blog, like what's happening day to day. And then Facebook, Goodman Report, Twitter, Goodman Report, Instagram. If you'd asked me 5 years ago, Stephen, would Instagram be important? Well, actually, it's interesting. It's kind of like, unfortunately, I get a little sidetracked with the reels now, but it's a very important place to also showcase our listings and our market knowledge. So any of the major social media platforms is a good place to follow us.
Awesome. Well, thank you for doing this. I'll put all the links down below the video as well as in the audio podcast, but thank you both for doing this. Appreciate it.
Great, and we can't wait to having our first addy deal, bringing an apartment building to the market.
Awesome.
I think it'll be really fun.
Yeah, it's going to be exciting.
Okay.
Thank you.